Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're going to decipher something that's been in the headlines over the last couple of days. Some people think that putting money in the stock market is investing. But in the past week, we've seen the power of social networks to mobilize large numbers of people to undertake an otherwise unnatural transaction en masse, all at once. The nearly dead company GameStop has been making headlines in recent days. A number of people are probably wondering why GameStop stock has been surging. It doesn't quite make sense. So before I explain what happened to GameStop, you need to understand short sales in the stock market. So imagine you think that a company's stock is going to fall. You pick a company, any company. Let's choose Boeing, for example. Boeing is trading at $197 a share, give or take. And let's say that you want to short Boeing. You borrow a share from a broker, and you sell it immediately at its current price. You then hope the stock's price is going to fall so you can buy it back at a lower price and return the shares you borrowed to your broker. You make money on the difference. So if Boeing shares fall to $190, you could then buy the stock back for less than you sold it and profit on the difference. You're going to decide to cover your short position by purchasing the stock at $190, and now you're in a safe position with a profit of $7. But if instead of the $197, the stock shoots up, say, to $205, well, you still need to return your borrowed share to the broker, except now it's going to cost you $8 to buy that stock back at a higher price. You would be facing a loss of $8. And since the stock could continue to rise indefinitely, the losses for a short seller can continue to increase indefinitely. You've got to replace those borrowed shares, and the more the price rises, the bigger the loss. Now for GameStop, a few weeks ago, someone on Reddit on the Wall Street Bets page noticed that a hedge fund had taken a massive amount of short trades against GameStop. The one reader convinced everyone on the thread to join forces and buy as much of GameStop stock as humanly possible. They pushed up the stock price in the short term, and the short seller was immediately exposed to billions in potential losses. Eventually, the losses grew beyond the $13.1 billion value that the hedge fund was worth, and eventually the hedge fund was forced to declare bankruptcy. Now we have the Reddit thread combing through other hedge fund positions with massive short sale exposures, so they can short squeeze them into bankruptcy as well. Some of the brokerage houses are crying foul, but the truth is, they just lost at their own game to the masses. This hasn't happened before. And now we're starting to see similar assaults on the shares of AMC Entertainment, which nearly tripled in value on Wednesday. Now folks, this is not investing. This is called gaming the market. It's pitting massive distributed liquidity against concentrated liquidity in the brokerage houses and in the hedge funds. Today, 90% of the trading volume in the market is based on large computer-based trades that are aimed at squeezing out small profits. The initiative for these trades are software programs written by quantitative analysts. These guys and gals are mathematicians who analyze the performance of the markets and try and develop algorithms that give the brokerage house, the hedge fund, or an investment bank a quantitative edge in the market. So, as a simple example, a computer program that looks at the price of Boeing, our example stock, on the London exchange might notice the stock is trading a few pennies higher in London than on New York. The software would then exploit the price difference by purchasing the stock in New York and immediately selling that exact same share in London, making a few cents profit off the trade with very little risk. Now, you don't make a lot of money on each trade unless you put a huge volume of cash through it. Throw too much money at the trade, and now you're eating your own lunch and negating the very price difference you were aiming to exploit. There are dozens and dozens of algorithms that have been created to try and outsmart the market. The folks who do this are affectionately called Quants, and Quants examine patterns of share trades in history in order to predict how to trade in the future. Now, there was no pattern in history that had thousands of people band together to gang up on a hedge fund to squeeze them out of a short sale. Since the move was unprecedented on such a large scale, it was an easy trap to create a several billion-dollar loss in a short time. The instigators of the squeeze play were guaranteed that the short seller would panic and buy back the stock. To the untrained eye, why would a company that's nearly dead have a stock shoot up out of the blue, out of nowhere? Well, now you know. But understand, this type of market manipulation would not happen with a piece of farmland, nor would it happen with an apartment building. Is it illegal? I have no idea. To me, it seems like the short seller's game in reverse, and this is not investing, it's manipulation. as you think about that. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.